All right, joined today by Ben Dean from WMS Solutions. How are you, Ben?
Yeah, well, thanks, Drew.
Mate, look, thanks very much for coming on. Ben is a specialist consultant with WMS Solutions. You're a certified accountant, aren't you, Ben? Chartered accountant, rather?
Yeah, chartered accountant, chartered tax advisor, Drew.
Okay, fantastic. So, look, thanks for coming in, Ben. I wanted to speak to you today specifically about tax advice and pre-planning business sales. For people looking to sell their business, what sort of things do you think should be the first things they consider from a tax perspective or a structure perspective?
Yeah, our focus, Drew, is normally on, what's our client's intended outcome. So fundamental to any consideration of a potential sale is what is the best transaction structure that's intended or in fact available to our clients. And normally, normally that involves a consideration of the entities involved that are operating the business, what assets are owned by those entities, and potentially any contractual matters that are involved. So the two major forms of sales transaction really is an asset sale, in which we're selling assets out of our existing structures, or in fact we're selling the structures itself. So in that case, if we're operating through a company, we're dealing with the shares in the company, or less commonly, you might have a fixed trust. We're actually dealing with units in a unit trust, for example.
And there's also other ways of getting the deal done from a hybrid sort of a solution of those two, or from an earnout perspective, or even one of the managers might look at buying the business or something like that. There's all sorts of different variations of that, isn't there?
No, there is indeed. In your hybrid structure, we commonly see, a business operation that's conducted over different legal entities. A common example where we have, say, IP or plant and equipment owned in one structure, and then business operations are conducted in the other. So in that sense, it requires an analysis of, potentially a sale of an entity on one side, and then, cherry picking certain assets out of others, and that may be driven by tax reasons. When we're structuring businesses, often we look at separation of asset growing or investment type assets in one structure, protection of risk. So that may involve tax efficiencies where it helps us to sell assets in one structure, but entities and shares are sold in another. And that may be, for example, to preserve contractual arrangements, including employees. If you're selling an entity, often it's an incentive to keep existing contracts with suppliers or customers, and maintain employees in their current positions. In the asset sale side of things, all of those things need to transfer.
Okay, and I guess moving on to tax planning, it's something a lot of people just don't consider before they put their business on the market, particularly issues like capital gains tax and possible concessions they might be able to achieve. Do you want to talk to us a little bit more about those sort of issues?
Yeah, that's really important, Drew, and often that drives how we're preparing for our sale. Access to capital gains tax concessions is critical, and often a variation between the form of the transaction can result in our clients getting very different outcomes. And unlocking the small business concessions, for example, which are quite involved, may mean a considerable difference in tax, and potentially eliminating any tax liability altogether. If I can give you a simple example, if a business is operated in a company and you're selling out value assets from the company structure, you may get some small business CGT involvement, but in a simple situation, you may have a tax impost of perhaps 30% or less. Whereas if you sell the shares, you could have a complete elimination of the tax liability. So the same value, the same assets, if you like, structured differently can operate very differently for our clients.
So particularly with larger businesses, if you've got a $1 or $2 million business and you don't do that planning, it could cost you a fortune.
Absolutely, and again, it's the after-tax outcomes for the clients which are central. You know, including potentially the use of superannuation, but really unlocking any available CGT concessions is paramount to a client entering into even considering to selling their business, let alone sort of, you know, having the initial negotiation with a potential purchaser and then trying to work out how it's done along the way.
Yeah.
Because often there's competing interests. We've got to make it attractive to a purchaser to agree to a certain transaction structure, as opposed to what may be suitable for them doing it another way. So in terms of negotiation, the transaction structure is important as actually arriving at a value.
Yeah. So they're the sort of conversations you're happy to have with someone looking to sell their business up front before we go to market. Just make sure that they're taking advantage of everything they can and the structure's right.
Oh, indeed. And we've done many transactions, Drew, where because those small business concessions are driven by effectively the complication is often getting into the concessions. Once you're in them, they operate quite logically, but they have, you know, definitions around what is small, and small is for those purposes a turnover of $2 million, and that's aggregated with you know, other controlled entities and connected entities, or meeting a maximum net asset value of $6 million. Okay. Now, in dealing with the latter, often there's clients that have assets within, within their group of entities or own personally, which with some management going into a transaction, you can fall below that threshold. Okay. And we've done many instances where we've restructured asset ownership, to give ourselves the best chances of meeting those conditions.
Okay.
Keeping in mind, of course, tax minimisation versus tax avoidance type considerations.
Yeah, sure. Okay, and tell us a little bit about WMS itself. You're based at Robina, so you're pretty central. How do people find you?
Yeah, Drew, thanks. We're based at Robina in the Rocket Building there, just next to the train station and the Titans. We're a 7-partner practice, I suppose generally operating within small to medium-sized businesses. We have a good range of clients. We act for everyone from smaller mums and dads, high net wealth individuals, up to listed entities. Yeah. And I suppose we have quite a good cross-disciplinary involvement there. So.
Okay. Look, I really appreciate you having a quick chat to us today, Ben. And obviously, if anyone's looking to sell their business, we recommend they get in touch with you and get that planning right up front. If you want to have a look at Ben's website, it's wmssolutions.com.au, and they can get in touch there as well. And look, just appreciate you coming on, and it's invaluable advice for anyone looking to sell, and appreciate your time, Ben.
Yeah, thank you, Drew, for the opportunity. I'd welcome a chance to speak to any of you, any of your potential referrals there, and certainly have a chat to them. I believe in investing some time in a potential client, such that the client's not concerned with being on the clock right from square one. I generally like to form a view whether we'd like to work together, invest some time, and then we'd see what we could do beyond that.
Yeah, that's fantastic, mate. Appreciate it. We have a good day, Ben, and we'll chat again soon.
Yeah, thanks, Drew. Appreciate it. See you, mate. Bye-bye.